Did you move away from the NAIRO, the non-accelerating inflation rate of unemployment? Is it more flexible in this regard as well, as there's not a very strict framework, but a more general, flexible way of thinking about it?
Yeah, that's clearly the case. So we will continue to write down our own estimates of NAIRO, of the natural rate of unemployment. Of course, that's only one factor we take into account when we talk about maximum employment. One of the big lessons of the last crisis was how much room there was in labor force participation, which performed really quite differently than expectations and better. So we're really looking at employment to population and the size of the workforce and things like that, as we always have, broader things. So we'll always write down estimates of the natural rate of unemployment. What we're really saying, though, is we're no longer going to raise interest rates just because, for example, if unemployment were to be well below our current estimates of the natural rate of unemployment, that wouldn't be a reason to raise interest rates unless we see troubling inflation or other imbalances that could threaten the achievement of our mandate. And that's a significant change. If you read the transcripts that were released of 2015, there was a lot of discussion of the issue around, could we let unemployment go below the natural rate? We saw what happened. I mean, we were the first group on the committee to see a sustained period of very low unemployment in many years. And we saw that it didn't produce troubling inflation, and we very much took that on board.
And by doing so, you take indirectly some inequality considerations into account as well. If the labor market works well, it helps the less well-off more. Is this a consideration as well, the inequality inclusiveness component?
Yes, the sense of our looking at maximum employment as a broad and inclusive goal does include that. And you'll notice that we have been talking more and more about various kinds of inequality that have been sustained and have grown in our economy over the years. And there's a reason for that. And that is that we think they connect directly to our maximum employment goal. So maximum employment, if you take that statutory goal seriously, it isn't achieved if there are lots of people not working around the edges of the labor market who could be working, who constitute potential labor force. And there's a lot of that in minority communities, low and moderate income communities. So we focus on it, and we never really did just look at the aggregate data, at least in recent years, but we will continue to talk about those longer running features of the economy, and we'll continue to take them into consideration in looking at maximum employment. I should add, though, that we do understand that those issues are important national issues that require a society-wide effort, and that's business, that's fiscal policy, that's the Fed. And what we can do, we will do, and it's important, but really the main answers have to come from education and training, and it has to become a national goal, I think. And we're hopeful that will be the case.
Okay, so let me move on a little bit to the inflation dynamics. Because there's, of course, a danger we might end up like in Japan, that there's huge right now in the crisis, there's this huge deflationary pressure because, forced saving by individuals. But on the other hand, there might also be a pent-up demand, and there might be inflation whipsaw, you might go back. So we might end up, in a situation where we have to be very aggressive, put the foot on the accelerator, but then we might get stuck in a low inflation environment for quite a while, or we might also end up in the other extreme and pent-up demand kicks in, and then inflation will come back up. So what do you think are the essential elements to control this whipsaw mechanics, which might occur or might not occur, or we might just get stuck in a low inflation environment? What do you see? How does the new framework help us in this to manage this better, or help you to manage it better for our economy?
Yeah, so a couple of things I would say about that. First, as you suggested, in the near term, as the pandemic recedes and we see potentially a strong wave of spending as people return to their normal lives and begin consuming various services, there could be quite exuberant spending, and we could see some upward pressure on prices. And by the way, at about the same time, we'll be seeing measured inflation go up because of base effects as we lap the low readings of the first of March and April of last year. So, in fact, that's quite possible. Indeed, that is in the forecast of many economists. But the real question is, how large is that effect going to be, and will it be persistent? So, because clearly a one-time increase in prices that isn't very large is very unlikely to mean persistently high inflation. And that just is a function of the underlying inflation dynamics of the U.S. economy as they have been in the last many years. As you know, we have a flat Phillips curve, meaning there's still a small connection, but you need a microscope to find it between slack in the labor market and inflation. We've also got low persistence of inflation, so that if inflation were to go up for any reason, it doesn't follow. Inflation doesn't stay up, and that it used to be. If you go back to when I was an undergrad at Princeton, you had a steep Phillips curve, and it was combined with highly persistent inflation, and that's what gave you the inflation that I graduated into in 1975 and later in that decade. So dynamics will change, but they don't change. We don't think they change, quickly or on a dime, and we'll come back to that. I also think, let's say that does happen. Let's say we have a strong economy in the second half of the year, and that continues. Remember, we're a long way from maximum employment. There's plenty of slack in the labor market. Unlikely that wage pressures are going to be reaching a level that would support higher inflation. Also, second, the other factor I'd point to is look around the world. Shortage of demand in lots of large advanced economy countries around the world who began this crisis at deeply negative interest rates and have had little policy space with interest rates. Now, there are other things they can do and they aren't doing, but that all is going to hang around for a while. And the U.S. economy is strongly integrated with the rest of the world, and that's going to matter. I should add, of course, if inflation were to move up in ways that are unwelcome, we have the tools for that, and we'll use them. We will use them. No one should doubt that. That's, in a way, too low inflation is the much more difficult problem to solve.